We've been in an environment for multiple years, really better part of at least a decade up until 2020, when we had so much stability. You had 1.5 to 2% inflation in the United States. You had 2 to 2.5% real GDP almost consistently. And then it got a little bit really kind of eerily believed in that would continue way back in 2017, which I think the record books will record that was the most low volatility environment, particularly for the S&P 500, where I think the number of days that the VIX was below 10 set an all-time record by a lot. And the narrative of no volatility forever became widely believed. In fact, I was on CNBC in July of 2017, and they said, "What's your highest conviction idea?" And I said that this low volatility environment cannot endure and volatility will go up fairly substantially. And at that time, the consistency of low volatility had endured for so long that there were a narrative developed that we would never have volatility again. In fact, I said, I think the VIX, which was when I was on CNBC, it was at 9.85. It went by on the crawler. And I said, I think it's going to quickly go above 15. And there was a debate where people said, no, it'll never go above 15 again, because the market has structurally changed. And of course, it wasn't terribly long thereafter that volatility really picked up, and it really became very evident in the fourth quarter of 2018, when suddenly we had a bear market in a very compressed time frame, a greater than 20% drop. Then we went back to a new high. Now we've had another huge drop in the early part of 2020, then a big rebound. And I think this volatility that we're having is extremely likely to endure with these moves that are pretty high. And beyond that, I think that we're entering an environment where on a more macro level, that we're probably going to have a fat tail event, I think, in the next few years, which means we can't keep going at 1.5 to 2% inflation forever in the context of all of these shocks to the economy with COVID and all of the aftershocks that are still coming about that, and the enormous government stimulus, which is designed, of course, to try to calm things down and take volatility of the market, but it's at such an extreme level with the deficit at 16% of GDP and the likelihood for almost certainty of much more stimulus, we're going to get a lot of volatility. So what's curious is that the United States stock market has once again, it seems like no matter what you throw at it, it outperforms most of the rest of the world. Here this year, many European stocks are down very sharply, but the NASDAQ is up something over 20%. The S&P is positive. The United States has so massively outperformed. And what I find curious about that is that the forecasts for U.S. GDP for 2021 on a consensus basis, they've been guessing about 2021 now for a year and a half. The guess for the United States is quite a bit lower than the guess for the world, which I find very odd given the outperformance of the United States stock market. I think the U.S. guessing is 3.9, at least it was earlier this month, 3.7 rather, and the guess for the whole world is 5.2, which suggests that the world ex-U.S. is expected to grow much faster. Now, I don't know why they expect that, but that is the consensus. And yet the United States stock market is by far the strongest. Well, why? How could that be? Well, the simple answer, I think, is the amount of stimulus has just been more extreme in the United States than other places. And especially the money spray, as I call it, the money going out to, extra unemployment benefits, which was very significant, gave people more money than they had even when they were employed, before they were furloughed. Over about 3/4 of low wage earners earned more under the money spray, unemployed, than they did employed. And also our deficit spending and our balance sheet quantitative easing has been pretty enormous. And so it seems that our economy has obviously rebounded very sharply, in particular the housing market, which is really, it's just gone on a tear thanks to, I think, all of this money and the fact that interest rates have been kept low and the Fed seems committed to keeping them low. Interest rates are now lower than the growth in wages. The actual interest rate on a mortgage is lower than the growth in things like average hourly earnings, which is a pretty unique phenomenon. That hasn't been the case in decades. And a lot of things suggest that interest rates are artificially low. I like to look at the ratio of the price of copper to the price of gold. It tends to be a signpost for where the 10-year Treasury yield should be. And that ratio has been moving up. That ratio suggests that the 10-year Treasury yield should be at 1.5, but it's at 80 basis points or 85 basis points. We look at other things like cyclical versus defensive equity performance. that also shows that the 10-year Treasury should probably be at 1.5. We look at a lot of things like this. If you look at the 7-year moving average of year-over-year GDP, which is an odd statistic, but it happens to be extremely helpful in determining a central tendency for the 10-year Treasury yield. And that one says the 10-year Treasury yield should be at 3.6. So the yields are really low, and they're being held low probably somewhat artificially by the Fed. But Jay Powell has said in plain English repeatedly that he does not want negative interest rates, doesn't believe in those. I applaud him for that. For that reason, I think we are not in the danger zone. Negative interest rates would be a real problem. But he also says he is committed to sort of whatever it takes, almost a Macron sort of statement on the quantitative easing, that he doesn't see any limit to the quantitative easing. And that's a good thing, I guess, if you want low yields, because there's nobody else really that has a natural demand for longer term bonds at these levels. Foreigners have been selling U.S. Treasury bonds for quite a while now, and in pretty good size. So there's no buying net from foreigners. Pension plans can't buy Treasury bonds, considering that they need a 7% funding sort of assumption, and the Treasury bonds yield 80 basis points on the 10-year. So who's left to really buy them? Well, it's either retail or the Fed, and it's pretty clear that this year the Fed has pretty much bought all the issuance, or lent the money to buy all the issuance of the Treasury bond market. So that's holding things together. I think, though, that the unevenness of the V-shaped recovery, if you will, it's very uneven. And that's not surprising when you use such a blunt instrument, such as this money spray and all of these PPP programs and all these other things that are kind of unprecedented. They're very ham-fisted and they have very uneven consequences. So what we've seen is still very high unemployment, still a lot of job losses at low-wage jobs. But we've seen full employment recovery at higher-wage jobs. We've also seen a strange phenomenon. This is the first recession in history where personal disposable income went up because of the money spray. If you didn't have those transfer payments of nearly $3 trillion, we would have had a collapse in consumer spending. However, we actually had a big increase in personal disposable income because the government provided all of that money. So the consequence of that has been also very uneven responses to this recovery. Spending is up tremendously for low-income people, because they spend all the money they get from the government. So the net effect of this has been, to a certain extent, economic unevenness, I think an increase in wealth inequality, and other things that will be echoing through. I also think that in 2021, we're probably going to see some slowdown in employment for what I would call a little bit up the ladder of the economic spectrum, call it middle management. One of the things I think I've learned as a CEO from work at home is you get the opportunity to analyze your business through a completely different perspective. You know, you're so used to being in the office, you have your way of interacting, and now it's all virtual. It's all Zoom meetings and Teams meetings. And what I find is I feel like I've gotten a fresh perspective on who's really working and what they're producing in terms of getting communications on this kind of routine basis. And some of the people who I thought were contributors at a middle management level, they've vanished from sight. I can't even find them. I haven't heard from them in months. And so I sort of say to myself, do I really need these people? And I've taken minor actions, nothing significant, but I've actually furloughed a few people, just saying, I've come to the conclusion that you're just watching other people work. And I also think that one of the consequences of work from home will be migration trends, which are fairly evident already. San Francisco has huge emigration going on. There's an explosion in houses listed for sale in San Francisco. It's triple where it was any of the last 5 years. And here, I'm in Buffalo, but in Southern California, I have friends that are trying to get out of Southern California, and they can't get a moving company to give them an appointment because they're too busy. They're too busy leaving California. And people are moving to Boise and Salt Lake City and Nashville and Austin, Texas. And you see incredibly tight supply in those housing markets, and really, significant shifts here. And so I think that will be disinflationary for wages as a one variable analysis, because I think that when people move from San Francisco to Boise, I don't think that they can command the same amount of income. And I think that will be a disinflationary force for that area of the workforce that is not really protected by these government programs, but is not super high income, kind of that middle management area. So I'm thinking that the consequences of the government's response to the COVID situation and the economic, collapse is probably going to be negative for the dollar fairly substantially in the longer term. The dollar did weaken. It's now stable, but not strong. It's just stable since August. But I think longer term, there's a high probability that the dollar declines fairly substantially because historically, the deficits, when they grow, and in this case, it's the budget deficits that's dominating, it's extremely highly correlated to a weaker dollar with about a 2-year lead time. And of course, the deficit exploded about 8 months ago. So we should expect the dollar to head lower sometime during 2021 or early 22. And I think that will have an effect on relative performance that doesn't favor the United States as much as it is so powerfully outperformed looking backwards about 10 years.